Greetings and welcome to the ROI Clear podcast. My name is Ray Hightower, and today we are fortunate to have as our guest Mr. Casey Stratton. Casey Stratton is managing member of Tamarack Capital. We're going to dig into exactly what that means. This is a man with over a decade of real estate investing experience, primarily focused on multifamily. He has an engineering background, material science engineering, and we're going to explore multiple facets of this gentleman. Ladies and gentlemen, please join me in welcoming our guest, Mr. Casey Stratton. Casey, welcome to the ROI Clear podcast.
Ray, thanks for having me.
Glad to have you here, man. Really glad to have you here. To kick things off, why don't we start with our elevator pitch? And for those who are new to the ROI Clear podcast, Casey Stratton is on an elevator with someone he wants to influence. So, Casey, what would you say to that person in the course of an elevator ride?
Well, yeah, I think to give some light into my background, growing up, I'm from Washington State, and I grew up with my mom telling me stories about Bill Gates and Microsoft. And so from a young age, I was like, I want to be an entrepreneur. I didn't quite know what that meant, but years later, after going through grad school, I got a job in tech and graduated into the Great Recession. And pretty soon after graduating, I got laid off from my job, and that was really a big wake-up call for me on the fragility of these W-2 jobs and how they can disappear, and companies are loyal to their investors and do what they need to do to protect the bottom line. So after trying to search for a job in high unemployment, I did start working back again in tech, but that experience made me want to understand more about how to invest and grow business and really control your own finances. And so that led me into the financial independence retire early movement, trying to invest and build up your own asset base. And a natural component of that is real estate. I saw that was a excellent avenue for generating really more predictable and healthier returns than investing in the stock market. So I started off talking to my wife, and while she was 6 months pregnant with our first son, I found 2 duplexes, and she was like, "Why 2?" I'm like, "Why not?" But she supported me, and made tons of mistakes on the way on trying to self-manage and all that. But that was my first step into real estate. Since then, I started raising capital to syndicate deals that are larger, and been growing that for the past 5-6 years.
Excellent. This is a remarkable background. You started off in tech. What was your role when you were in the tech industry?
I was in finance. I was a senior financial analyst.
Got it. All right. So managing the money. And so that there's a direct connection between what you did in the tech industry and what you're doing now.
Yeah. So, when I was in grad school, I was studying finance. Coming from an engineering background, finance just made the most sense for me in the business aspect. And I just always loved to see how money moved around, how you can, leverage money to make more money. And it was just fascinating and a very deep topic.
Yes. And what's so wonderful, we have many people, and certainly you do as well. We have investors and clients that we deal with, and I'm sure you have them, who may get a degree in one thing and they end up going into something totally different. And I think the important thing is what happens to your brain when you're earning that degree. What level of discipline are you learning? What's happening to your character when you're doing that? I think, but I don't want to put words in your mouth. I'm expressing an opinion here, but I don't know if that's something that the guest agrees with necessarily.
Yeah, no, so I have two young boys, and I think about what do I want to advise them on their education as they, exit the house. And I don't have a definitive answer on that, but I was encouraged to study engineering and learning how to solve problems in a systematic way. And I think it was a very beneficial kind of skill set. I don't use calculus or any of my material science stuff anymore, but being confident that you can systematically think through something was a immense skill. And then going into business school, I didn't even know what the difference between marketing and advertising or accounting was. So that was critical to learn kind of the basics of business to be able to move into the finance world.
Right, right. And so you've moved from tech. You said, of course, you did your undergrad in material science, and it's got to be exciting things, seeing things that are happening in the material science world right now. What's happening with batteries and what's happening with rocket ships. I'm thinking about SpaceX and Tesla specifically, but That's got to be exciting. Do you get a chance to follow what's happening there at all, or are you thoroughly focused on investing?
I'm pretty much like a lay person in that aspect now. I watch what's happening with electric car vehicles and the battery technology, and it's just amazing what they're doing in there. But I've pretty much lost all that knowledge over the past 15 years.
Got it. All right. So you left the W-2 world and you left the tech world, left the material science world, and left being a chief financial officer in the tech world and moved into your investing. You've got your two duplexes. Why don't you tell us some stories about those right there? And I'll share this. Well, no, please tell us about the duplexes.
Yeah, so I found one on Craigslist and just riding my bike through one of the neighborhoods. So it was very much off-market deals. I'd never really done a investment property before, and my mom was asking me, "Do you really want to be doing this?" I didn't come from a really capitalistic family. They were very much the traditional W-2 401k type thing.
Hmm.
So when I closed on them, I was reading everything I could on blogs and online on how to properly do this, but I was so scared to lose money on them that I wanted to try and, pinch pennies and do everything myself. So a big component of that was I was self-managing. And
Mm.
I think everyone should maybe have some experience self-managing property, if not for very long, just to understand the value that professional property management brings in. Um, I went through a lot of stories of not getting proper move-in reports, having to release deposits, they trash the place, not managing tenant expectations, collecting half a month's rent, trying to help them out, but
Mm.
essentially losing money on that. So uh, after about 2 years, brought on a property management company, and that really opened my eyes about if you want to be doing anything, but especially in real estate, you got to be building a team that fills in your weaknesses. I'm not a good property manager. I'm good at deal analysis, finding deals, working with investors, and that's what I need to be focusing on my core competency. I have a partner who focuses on operations, we're running crews through, and we use property management on our portfolio. By leveraging all these different partners, we're able to get the best streamlined product for our investors and get the best returns for them.
Excellent. Classic example of who, not how.
Oh yeah, exactly.
Yeah. So you started off with the duplexes, got some experience there. No, don't take half the rent just to help them out because you're setting a precedent there, and it's not a precedent that you want to set. And you also learned that there were certain areas where you personally wanted to focus, but it would be better to get someone else to handle the other areas where that are not in your area of focus. So
Mhm.
you got the property management property management company on board. And tell us about that. What were the interviews like? How did you choose the particular management company that you went on board with there?
Yeah, so I pretty soon after the duplexes started investing in our local downtown and some commercial real estate. We had some
Hmm.
office buildings, some retail, we did some development. And one of my investing partners had his own property management company. And I saw how they operated these commercial properties. And it was, pretty serendipitous. I was like, can you manage my duplexes? And after that, it was history.
Relationships.
Yes,
So
exactly.
you're very good at building relationships.
I try. It's definitely a skill that you need to invest in.
Absolutely. Invest in. Okay. So after the duplexes, what was next? You had the friend, the contact that you worked with who was investing in downtown. Tell us about the next step beyond the duplexes.
Yeah, so it was the duplexes and getting into some commercial properties. At the same time, one of my business partners, we joined up to start a boutique angel investment fund. And this was for investing in startups in our community. If you can see the common thread here, we really want to invest in the Tri-Cities area in Washington State.
Hmm.
And so this fund we'd raise money into, but then we also had a software development team where we'd build software products for, commercial clients, but we also would find entrepreneurs who had an idea for a tech product, and we would fund that and then have our software team do at cost development so we could get a minimum viable product and then go raise money on that for the next stage of development. So it's very boutique, early stage. But that was my first experience in actually bringing in outside investor capital as limited partners. And after after about 5 years, I realized, this real estate thing, why don't I just raise money for this, right?
Hmm.
And go for larger products. Of course, I was naive to not realize that there's an entire industry out there for putting together syndications or funds. And so that was a whole new area of learning and growth for me. But yeah, that's kind of how we grew into the larger fund model.
That's fascinating. You were an angel investor. Are you still doing angel investing on tech startups?
So we ended up selling one of our core products to a company out of California, and they
Yes.
wanted to hire the development team. We'd already built up a portfolio, and so at that point, we just kind of closed out the fund, and right now we're letting the investments ride out and mature and grow or fail.
Right. And I'm sure there are things that you learned as an angel investor in that industry. Everything, well, let's take a look at it. You had the angel investment fund. You had the software development team that was building your minimum viable products in-house. Then you had your expertise, your background in tech. I'm sure at this point in your career, you understand who, not how. So you brought on other experts in other areas to get things done, such as the capital raising. And and can you tell us some of the lessons that you learned there that fit with what you're doing today as a real estate syndicator?
Yes, I think a key lesson is you think it's easy to be an investor. You're the one in control with the money and you just got to write a check. But we brought on investment partners who wrote large checks into the fund and were sitting on the board. And watching how they would evaluate a deal was extremely eye-opening. You
Hmm.
listen to the pitch and you're like, oh yeah, I think everyone gets excited and they want to go out and oh yeah, let's get this product and corner the market. But asking the right questions of the investors and how big is the market, how good is the team? So much of it is betting on the jockey and learning to be diligent and rigorous with your thinking through the deal evaluation directly then translated over to how we look at properties. It's not just underwriting and building an Excel model, but looking and asking the right questions about the market, about the location, condition, what's our improvement strategy. All these things going together to you got to put the pieces together to get the best investment opportunities.
So what you're saying is, in being an investor is not easy.
Absolutely not.
So you're evaluating the deal, and in being part of these meetings as an angel investor, you're listening to the investors as they're asking these questions. They're asking about, tell us about the deal, tell us about the team. They're probably looking at downside pretty closely.
Yeah, protecting the downside. I guess I would say this. Being an investor is about directing flows of capital.
Hmm.
And that sounds very simple if you don't know what goes into that. But being able to properly direct capital into opportunities and resources is what makes a good opportunity. And these skills to understand how to evaluate that is something that you really got to invest in and learn on. And having advisors who can kind of show you the way on that was pretty critical.
Right. Directing the flow of capital. They're making these decisions. All right, great.
Mhm.
So angel investment firm, and then so you're running the angel investment firm. You're building MVPs. You're involved in investor pitches. You've got investors coming in. They're evaluating deals. All of this learning is coming into your brain from many places. At the same time, you've got real estate going on. You've got the duplexes that you've done. Tell
Mhm.
us about the next real estate step. We're running kind of a parallel stories, like a great movie where there are parallel plots going on at the same time. So we've got your angel investing plot, we've got your real estate investing plot, we've got your life plot because you've got your two sons right now. You're thinking about what wisdom you're passing on to them. So all of these are going on at the same time. So let's shift over to the investment, the real estate investment portion. What was next in beyond the duplexes? When did you decide to grow in that area?
Yeah, well, you're absolutely right. There was two parallel arcs here, right? It was going
Yes.
from duplexes to commercial and development, while I was also growing my CFO career. And so I was
Yes.
head of finance for a number of different businesses, the software development company, and then I moved over to be CFO of my partner's law firm. And the
Hmm.
common thread here is that both of these roles was deriving revenue in a business out of billable hours of our staff. And so you can look at this, the incentive structure and mindset it creates is how do we try and get more profitable uh, by making people work more, get more billable hours in? It's a very simple
Mm,
calculation, right?
yeah.
And I did that for years and years, and it was quite tiring to go into Thanksgiving and Christmas, and everyone's taking time off, and your revenue naturally dips, and then you go into the new
Mm,
year trying to make payroll. And I think I had, 5 years where I didn't have a very good Christmas because I was working, trying to figure out how we're going to call in accounts receivable or get financing in place, but how do we, protect our staff and make sure we can make payroll? So it's very stressful.
right.
And while I was doing this, I'm also looking at the revenue coming in from the real estate. And I'm thinking, these buildings, they don't go on vacation during the holidays. They
Hmm.
just, if you manage them properly, create that
Right.
revenue. And so that was kind of the impetus of like, I saw the real estate being more scalable and controllable of a career investment opportunity. And so that's when I started saying, hey, let's take this model where we raise capital from investors and pair it with real estate and grow that as a business vertical.
Got it. Got it. So you're responsible for making sure that the people who are billing hours are billing hours. Bill constantly. And the most that a consultant would bill, well, typically would be like 2,000 hours a year, I would imagine, 40 hours a week, 50 weeks out of the year. But that's probably
So
a lot.
that's big law. They try and get their attorneys to bill
Yes.
2,000 hours a year, but it's
Okay.
generally in the most productive times, you're maybe 50, 60% billable on your hours. Otherwise, you're
Mm,
doing prep work, internal meetings, eating lunch, whatever, right? And so
sure.
generally we try to build a model where it's like, can we even get to like 20 hours billable
Yeah.
in a week?
Got
And
it.
so, but yeah, I just got tired of being the bad guy cracking the whip and getting excuses of, you know, I don't have enough clients or I'm billing, but then they, do pro bono work and it's all written off. And so we had to find this balance of how do we do good in our communities, but still be financially feasible, right?
Yes.
We weren't trying to get rich off the backs of our staff. We were just trying to make sure the business worked and stayed afloat.
Right. And I'm sure they understood it, but they certainly would not understand it at your level because you're looking at that spreadsheet every week or probably every day to see
Hmm.
what the billable hours are. And like you said, when you get into the holidays, I know you want your people to go through, recovery, spend time with their families, all that stuff, live a life. But at the same time, they are also vital components in your machine. And so
Hmm.
when the components of the machine aren't there, yeah, yes, I can see how that would be stressful. I can see how that
Yeah.
would be stressful. All right. And so you're looking at your buildings and they're producing revenue like clockwork, like boom, clockwork.
Yep. Exactly.
And so
So,
you saw that on one hand, you had people who were sometimes producing revenue, and then you had buildings who were producing revenue like clockwork. And so then you had to make a decision, or you made a decision. I won't say you had to,
yep.
but you made a decision.
It was great timing too, because I went into my partner, the CEO's office on a February 2020 and said, hey, I'm going to be pursuing this new avenue. I can make the transition as, quick or long as you'd like. And in the next month, the pandemic all of a sudden reared its head and the stock market crashed. And so I was like, okay, how am I going to raise money when the stock market's down 30%? So
Right.
it was kind of a nice crash course in timing.
Right. Okay. So you had that conversation and you focused on real estate. So then, and that was right, February 2020. We all know what that was. And very big event, planet wide for us all here. So how did you manage your way through that? Because we both remember that, and our colleagues in the industry remember this. How did you manage your way through that global time?
It was a really difficult period. My sons were 3 and 5. And so I was one of
Mhm.
those parents trying to keep the company afloat because I was still the CFO for all the way through the summer, applying for PPP loans, just trying to get grants and make sure that, our staff are getting paid. Um, my oldest son started kindergarten virtually, which was just a complete nightmare trying to get a
Mm,
5-year-old to sit in front of a laptop. Like, what am I doing here,
sure.
right?
Right,
And
right.
trying to connect with potential investors. The networking just completely stopped. So it was a really difficult summer and fall. And I really had a lot of questioning of like, did I just completely make the wrong mistake here? But kept
Mhm.
plugging along.
And it worked well. And so what was your next acquisition after the duplexes? What did you focus on next?
Well, on the fund, we didn't have a lot of capital raised, so we had about $500,000 just starting out, and
Hmm.
found a fourplex that just was in a great market, needed a little bit of rehab. So started small, grew into a fourplex, and that one actually I mean, that was in the fall of 2020 where multifamily started shooting up. So we doubled our money on that in about 12 months. Kind of a nice little investment, but then scaled from there into the value add multifamily space. I saw the value add where where you have a business plan going into the acquisition of how you're going to boost the net operating income. It's a very controlled way of juicing up investor returns without trying to
Hmm.
speculate on how our interest rate is going to move, how's population growth going to happen. You try and do all that analysis and have that as additional tailwind to your investment, but you really control that initial bump in value.
Right, right. And that's probably one of the things that attracts you to multifamily and commercial real estate in general.
Absolutely.
That
Yeah,
level of
there's a lot of ways to make money in real estate. We've done development, we've been in different asset classes, but I just see the predictability and controllability of the value add space. Obviously, margins have been squeezed a little bit as rates have gone up, but it's, I think, just one of the best asset classes out there.
wonderful. All right. You have a quote, I could call it a quote or a post on your one of your social media outlets. Yes, we're going to get you about something you did on social media. Uh, on your LinkedIn, you have this sentence, this phrase: "Bad investments aren't failures; they are lessons." And I was wondering if you could unpack that for us, please.
Yeah, so I think there's risk in everything you do. And one of the risks people are always worried about the risk of actually taking action and making an investment. What if they get it wrong? But there's also a risk of what if you sit on the sidelines and never actually try and progress forward? The opportunity cost of not taking action is so neglected or unseen by so many people. And so I've just seen the times I take action and move forward, there's always uncertainty in what you're doing, but you try and control for that as much as possible, but keep moving forward and you're going to learn lessons. So let's take that back and apply it to my duplexes.
Sure.
I maybe had the fortunate situation of being naive and young, but I took action and bought these duplexes, thinking that I should self-manage them. Clearly a mistake, but I learned that after 2 years in a nervous breakdown that I need to be bringing on partners, and that's been a
Mm,
huge thesis in our growth model is the who not how, finding those partners to handle the tasks that they're strong at, and I can focus on the core competencies. By making that mistake and in that situation, I have an even greater appreciation for what goes into good property management and good operations, and how good operations makes or breaks an investment.
excellent.
Wouldn't have learned that if I just kind of sat on the sideline and read more blogs.
That takes a very healthy mindset, and that takes a certain level of emotional health, I would argue, to see it that way.
Yeah, try.
Got it. Got it. There's so many more questions I could ask you about. There are things I want to ask you about finance and what you're doing with your investors, how you attract investors, and all of that. So I certainly want to have you back at some point. As we wrap up, and this has gone really quickly. I always monitor our time, so it's gone really quickly. As we wrap up, it's clear, Casey, that you spend a lot of time sharpening this brain, this gray matter between your ears. What are some things that you are reading or listening to make sure that you stay sharp in this industry?
That's a great question. So I'm a avid lifelong learner.
Mm,
Getting into real estate 10 years ago, I was reading everything possible about the mechanics of how to underwrite, strategy, how to manage tenants. And that foundational knowledge was critical for that growth over the past 10 years. Um, I still keep up on the market conditions. That's a lot of reading newsletters from other brokers, investors, a lot of podcasts listening, see what other people are going through. But my reading has really expanded into other aspects of my life. Like I got this book right here from Peter Attia. It's called Outlive, and it's about it's a little morbid, but it's what are the four ways that people generally die, and it's
oh,
through heart disease, Alzheimer's, things like that, cancer. And what are ways that you can do right now to make yourself healthier, but also as you go into older age, how do you keep your health up as much as possible and not have a gradual slow decline that a lot of people do in their 60s and 70s? It goes into nutrition, goes into weightlifting, and make sure you keep your muscle mass. So that's been really important. And then I'm also reading a book called Golf is Not a Game of Perfect. I love golfing, and over the past couple of years, I've realized how much of that game is mental and not just, who can drive it, 300 yards. And so been trying to sharpen that aspect of my life too. But those are my main, education areas right now.
We want to make sure we include those. And I like what you're saying about golf. Yeah, definitely mental. Because when you're under pressure, how do you respond to pressure?
Yep.
All right. And then finally, Casey, how can people get in touch with you?
Yeah, so we got our website where we have our newsletter you can sign up for. It's Tamarack Capital, or excuse me, tamarack.rei.com. And then I also focus heavily on my LinkedIn presence. So you just search me there for Casey Stratton.
Wonderful. Casey Stratton, it has been a pleasure having you here on the ROI Clear podcast. There's a lot to learn from your path and from the career choices that you've made and from your success in running Tamarack REI. Thanks for being here.
Ray, it's a pleasure. Thanks for having me on.
And thank you for engaging the ROI Clear podcast. At ROI Clear, we buy multifamily apartment properties, we improve them, and we give people a great place to live. At the same time, we give investors an opportunity to enjoy capital preservation, tax advantages, and a solid return on investment. If you'd like to know more, click the link to roiclear.com down below. We look forward to speaking with you.